Mortgage delinquencies in Canada just hit an 11-year high. But here's the twist. It's not just about the missed payments. For Ontario homeowners, especially those coming up for renewal, this could be a defining moment. So if your mortgage rate starts with a 2, like 2.3, 2.4, 2.3, yada yada, let's talk. Now, look, if you are in Ontario and your mortgage renews in next 12 to 24 months, you need to hear this. Because thousands of homeowners, whether in Toronto, Durham, Hamilton, Ottawa, you name it, are facing a silent squeeze. This isn't loud. There are no alarm bells, but their payments are creeping up. Unsecured debt is rising, and home equity, well, it's not the safety net it used to be. If you are living in a detached home or townhouse purchased during 2020, 2021, boom, you may be especially vulnerable. Why? Because many of these mortgages were taken with ultra low fixed or variable rates. Fast forward today, and those same households are being asked to renew at double or more what they were paying. And if you've been putting off your mortgage strategy thinking, rates will drop soon or I'll figure out when I get my renewal letter, then delay may cost you thousands. Now's the time to get ahead of this. Here's what we are seeing day in, day out. First, the people are waiting too long. They assume that banks will offer a decent rate at renewal, but the truth is, loyalty isn't rewarded in today's lending world. Most banks send out an auto renewal offers that are not the best rate, not the best structure, and definitely not the best strategy. Second, there's a tunnel vision on interest rate alone. A lower rate does not always mean better deal. It's about the full picture. Amortization, flexibility, penalties, total cost. We have seen clients get locked into low rate mortgages with punishing break penalties. Others have extended amortization to keep payments low down, but ended up paying tens of thousands in more in interest. And third, credit cards and car loan debt is building up. People are trying to write it out, but those 19-20% interest rate, they aren't waiting. And the longer you delay tackling that debt, the more it snowballs. We have had clients who told us they wanted to wait and see what rates do, only to come back 6 months later with less equity, more debt, and even fewer options. Timing really does matter. Now let's do a reality check. Let's ground this with real recent numbers. According to Equifax Canada, Ontario's mortgage delinquency rate rose by 71.5% year over year in Q1 of 2025. That's the sharpest increase since 2008. Yeah, that financial crisis. In Toronto, the rate now sits at 0.23, still low by historical standards, yes, but direction is what matters. These aren't isolated cases anymore. It's becoming a trend. And from MNP's latest consumer debt index, 43% of Ontarians say they are just 200 or less away from not being able to pay their bills. 27% already consider themselves financially insolvent. And the average household, they just have around $800 left after covering monthly expenses. That's the lowest across Canada. Meanwhile, the inflation, while cooling in some categories, continues to eat into purchasing power. Groceries, insurance premiums, rent, they all have climbed up. And now pair that with elevated borrowing costs, and average Ontario household is in the tightest financial position it's been in over a decade. So while headlines say inflation is stabilizing, the reality for many families is that it's stabilizing at a painful level. Now, let's break down this in simple maths with an example. Let's get specific. Say you logged in a 5-year fixed mortgage in 2020 at 2.49 on a $600,000 mortgage. Your monthly payment would have been around $2,600 or $2,700. Now, if you are renewing at today's average rate of 5.49, your new payment jumps to roughly $3,300, $3,350, something around that per month. That's an extra $600, around $700 per month, over $8,000 a year. And that's not even including your car loans or other credit card balances that may have grown in the meantime. Now imagine this scenario with a $700,000 mortgage. that payment jump could exceed $900 per month. This is what we call the payment shock. This is very real. We are seeing that across the age group, from the first-time buyer to the downsizers. Anyone who financed aggressively in the past 5 years is now being asked to reset at much higher level. And here's the kicker. Many don't even realize the shock is coming. They see their renewal date in the distance and assume they'll deal with it later. But by then, it might be too late to restructure intelligently. Let me give you another real life example. This is this couple from Durham region in Ontario. We recently worked with them. They had a balance of $580 on their mortgage coming up for renewal. Their current payment was just over $2,500 a month. Their bank sent a renewal notice. New payment would be around $710 higher per month. At the same time, they had about $42,000 in credit card and auto debt, of course. The interest rate on those debts were 9 to 19%. They were overwhelmed. The numbers didn't make sense. They were considering selling the house just to break even. To release off some pressure, we took a different approach. We ran the numbers, explored every lender option, and structured a plan that reduced their total payment by over $600 per month. And that gave them the flexibility to reposition when rates eventually fall. They didn't need to sell. They just need a strategy that looked at their full picture, not just their mortgage. So what you can do? Here's a basic framework that would work for most Ontarians. If your renewal is within 12 months, do not wait for your lender's renewal later. Start now. You can ask for a full mortgage review, not just a rate code. Again, you can consider a blend and extend or early finance options also. If you're carrying a high interest debt, run the numbers on consolidating into your mortgage. This can drastically improve your monthly cash flow. Make sure you factor in amortization changes and long-term costs. Also prioritize flexibility, open terms, lump sum payment, privileges, and portability. And if your equity is tight or credit isn't perfect, explore a short-term fixed rate so that you can ride out to the next cycle. Now, some lenders offer flexible qualification programs without sky-high rates. You may also reposition again in 1 to 2 years, and that's okay. There's no one-size-fits-all solution anymore. Strategy matters more than ever. We hear this all the time. Should I wait for the rates to drop? Sure, but if your renewal is within the year, the cost of waiting could outweigh any future savings. You can always restructure again when the rates fall, but you cannot undo 12 months of higher payments. People say, can I qualify for a refinance? Possibly. You won't know until you run the numbers. We have helped families with bruised credits, reduced income, even recent job changes. The key is being proactive, not perfect. They say, isn't this just a short-term blip? And that's what we all hoped in 2022. But it's 2025 now and rates are still elevated. Even if the Bank of Canada cuts later this year, those changes may be gradual, not game-changing. Now, what's the takeaway? What steps you can take? Here are your 3-step action plan for this week. Find out your exact renewal date. If it's within 12 to 24 months, you're already in planning window. Use a mortgage calculator and run a stress test at 5.49 or even higher, 6.09. See how your payment changes. Do not guess. Next, gather your debts and income. Put it on one paper. Understand your full financial position, not just your mortgage balance. If you don't have a plan yet, that's okay. That's what we are here for. The important part is to start now, not later. And if your mortgage is coming up, and especially if you're feeling squeezed, let's have a quick strategy chat. No pressure, no script, just a real conversation with someone who understands Ontario's mortgage market. We'll look at your numbers, your options, and we'll give you a clear, no fluff path forward. It's free, it's confidential, and it might just save you thousands. So book a free session at the link given below. You got more control than you think. Thanks for watching. If you found this helpful, hit the like button and subscribe for the real talk on Canadian mortgages. See you in the next one.